Hey, everybody. Happy New Year. Well, 2021. Man, I couldn't wait for 2020 to get done. But, now that it's over, it looks like we still have some work to do. But rather get into, the things that sucked about 2020, I want to talk about what I'm excited about in 2021. So, with the help of one of my mentors, Barry Habib and MBS Highway, we created some great slides to share with you guys on housing and interest rate outlook for 2021. So I hope that you find this incredibly valuable. There's great information in here, and we try to stick to facts. We try to stay away from opinion, and we try to stick to the facts. You can make your own decision as to what you think is going to happen, but I encourage you to stick with me because there is some really great information here that's going to help you to make a valuable decision in 2021, whether it's in real estate or, maybe with some of your other finances. So with that said, enjoy the rest of the presentation. Okay, so here is our 2021 housing and interest rate outlook presentation, folks. So the first thing that I wanted to touch on was, the politics in the market, because I talk to a lot of people every day, and there's some people that are super confident about the politics of our nation right now, and some people are really nervous. They're afraid that the new administration is going to set policies that is going to be anti-business. And they think the market's going to crash, or they think that housing is going to crash. And the statistics just tell us that that just is not true. And by the time I'm done here, I think that you'll understand why. The chart that you're looking at right now was given to me by my buddy, Aaron Tucker over at Edward Jones. And it just shows you what the, the performance of the stock market, the bonds and the economy, how it's performed under a Democratic president, under a Republican president, under, whether it was a Democrat or Republican Congress, and then also when we have a Democrat as the president and a Congress as Democrats as well. And you can see that the last, illustration here of a Democratic president and Democratic Congress, the stock market averaged 12.3% a year. So, and this is also, you got to keep in mind that this is with inflation at 4.7%. Long-term government bonds were at 2%. So, I think the moral to the story is here. The markets don't really care about what, the political aspect of our government. What they care about is they care about the Federal Reserve. What is the Federal Reserve doing about our economy? I told everybody in 2019 that in 2020 we were going to go into a recession, and that you would see housing actually go up. I'm on videotape saying this to people, and everybody thought I was crazy. But if you look at the last 6 recessions, values actually went up during the recession, because what happens is that governments typically lower interest rates to combat a contraction in the economy, and the lower interest rates cause the housing market to go up. So here's some, we have Janet Yellen is coming back, this time as the Secretary of the Treasury. Janet Yellen, for those of you who don't know, she was the chairman of the Federal Reserve after Bernanke stepped down, and she is considered to be very dovish, meaning, she is not a deficit hawk. She believes in spending money to get the economy going. And Steve Mnuchin, who she's replacing, was constantly at battle with Jerome Powell, who is the chairman of the Federal Reserve now. And as you may or may not know, Jerome Powell was very, big on stoking the economy with more money. So if anything, we see Yellen is going to be telling Jerome Powell he's not spending money fast enough. You can see that also the Secretary of the Treasury is the one who actually signs the money. So I think that we can expect a lot of money getting pumped into the economy. Whether you think that's good or that's bad, I can tell you that what brought us out of the mortgage collapse in 2008 was the government stepping in and just calming everybody down. I often refer to them as the 1,200-pound gorilla in the room. It's like it doesn't matter what else is going on when there's a 1,200-pound gorilla in the room. That's the only thing that matters. And when the Federal Reserve and the Treasury are both intent on making sure that the money supply doesn't, dry up, and that companies and that private citizens are able to wait it out, then I think that, and for sure, it may not, I don't know how it's going to help your business, but I can tell you there are millions of people that are needing relief right now. So I like this particular quote: "Don't fight the Fed." Like I said, the Fed is the 1,200-pound gorilla in the room. And the chairman of the Fed, Jerome Powell, said that they intend to keep short-term interest rates near zero until the end of 2023. Now, I'm going to go through this in a minute and talk about how that can affect your interest rates. But, the Fed is arguably the most powerful financial institution in the world, the United States Federal Reserve. Nobody can touch them. They are the US dollar is the reserve currency. No matter what anybody tells you, we still live in the greatest country on the planet, and we are the ones that the rest of the world takes cues from. So the Fed has said that they're going to keep their rates at zero, but you got to remember that that doesn't necessarily mean that your interest rates are going to stay at zero. You can see over a long period of time, the Fed keeping their rates near at zero is kind of in tandem, keeps in check with what's going on with the mortgage rates, but not necessarily always. Sometimes you can see right here, like at this particular juncture, you could see that the interest rates actually went up when the Federal Reserve was lowering rates. You can see little bit of a movement up there, even though the rates were going down. We saw the same thing happen back between 2009 and 2016. You can see that the federal fund rate was pretty much at zero, for what, 7 years? But you can see that we had little spikes, right? Where interest rates went from 4% up to 5.125%, even though the federal funds rate was at zero or next to zero. And then we saw it again here where rates went from 3.5% up to 4.75%. You see that? So, we have to take a cue from the Fed as to, how they're handling monetary policy. Most importantly, bond traders are taking a cue from it, because these are people that are writing billions of dollars worth of checks for different bonds. These are portfolio managers, right? So they're the ones that are making your interest rate go up or go down. It's what's happening within the bond market. But a lot of what I hear also is, people are talking about, the government printing money. The government doesn't print money, folks. They issue debt. And we know that when debt goes up, interest rates go down. We know this to be an absolute fact. You can see right here, between 2007, this is when the government stepped in after the collapse. They issued a lot of debt. The Fed was coming in and buying treasuries and buying bonds. And what was happening to interest rates? They were going down. So this is not speculation, because we can look over here at France, and the same thing happened in France, same thing happened in Japan, same thing happened in Italy, same thing happened in the UK. When the government is quote unquote printing money, which they're not, what they're doing is they're issuing out debt, right? They're buying the treasuries and the bonds, and in some cases even corporate debt, right? What happens is that the debt goes up, and interest rates wind up going down as a result. So here's what we think is going to happen here. We know that debt causes interest rates to go down, but here's the other thing. The one thing that kind of everybody is talking about is that inflation could cause interest rates to go up on everybody. If all of a sudden we start finding ourselves with an inflation problem, then we're going to see rates go up. But we know that if the government's issuing debt, that's going to help interest rates. And we also know that technology is going to keep interest rates low because it's becoming cheaper to live. I know it doesn't feel like that, especially when you look at the housing prices going up, but housing is just one of the areas. I want you guys, especially the people that have been around for a while, think about what it used to cost you for your monthly home telephone bill. I can tell you my first cell phone was like this big and it's fit underneath the seat of my car and had a cord on it. It was $300 for 20 minutes. $300 a month I paid for that cell phone. Now you get unlimited talking for, next to nothing. Your cell phone has become more than just a phone. It's also a computer. It's a wealth of knowledge. So all packed up into this technology that we call a smartphone. It has brought the cost of knowledge down. It has brought the cost of banking down because you don't have to run to the bank every time you want to transfer money. You're able to use your phone. So and they're giving them away now for free. As long as you sign up for a contract, you can get an iPhone for free. You may not be able to get the newest, latest, iPhone 12 or whatever it is, the iMac or whatever they call them. But you can get a smartphone for free, and the cost of making a call is demonetized. I mean, the education, the commerce, you name it. Because of this, the cost of this is going down. We're going to see this also happen. I think you're going to see banks taking massive downturn because banks can't. The only thing that banks really have to offer us now is a physical location where you can go and talk to a banker. If you have any kind of experience, dealing with PayPal or Venmo, or I can tell you, I have a bank account and I do almost everything from my smartphone, right? So we know the technology is bringing the cost of everything down. We also know that entertainment is bringing the cost of our streaming is bringing the cost of entertainment down. Guys, I used to go to 2 movies a week about 4 years ago. My wife and I loved the movies. We went every weekend. Sometimes we would go to one and then we'd sneak into another. I have an 82-inch TV in my living room now. I've got Netflix, I've got Showtime, I've got Stars, I've got Hulu, I've got, YouTube TV. I mean, I just have an endless amount of things that I can watch for pennies on the dollar. I can remember when I had a Blockbuster account, I remember going to Blockbuster and them hitting me up for $20 because I was 5 days late on a movie. Right? So those days are over now. We have unlimited amounts of entertainment. We also have the cost of energy is coming down exponentially right now. And the reason why is because technology is advancing. We know, that your iPhone cost you less every year that goes by because of Moore's law, right? The cost of transistors are decreasing, so therefore they're able to offer things at a cheaper price. We're seeing this also, in all facets of life. Technology is, and I'm going to talk about this in a minute, is going to make the cost of just about everything that you own is going to come down, including food. Folks, the major cost for growing produce is the transportation aspect of it. When you have to take, a truckload of oranges from Fresno and ship them all over the country, the majority of the cost of those oranges are in the gas and the manpower that it took to transport them. Same thing with lettuce, and they're able now to take solar and wind energy, and they're doing vertical farming where they're taking computers, they're taking artificial intelligence for a fraction of the cost, and with no pesticides, they're able to grow it with like 1/10 of the water. And it's all in these vertical farms that they're building in buildings all over the world right now. So the cost of fresh, nutritious food is coming down, as well as the cost to, for vehicles and for, to energize your home. We also know that autonomous driving is coming. It's probably going to be here by the end of this year in some places in the country. Eventually, over the next 5 to 10 years, people are going to opt to not own a car anymore, because the cost to take let's say Tesla is going to have an autonomous fleet. If you can take a Tesla to work for 25 cents a mile, it costs you, let's say you live 10 miles away and it costs you $2.50 to take a Tesla and get to work, and $2, that's cheaper than it would have cost you in your own car, especially when you calculate in the cost of owning the car, the gas, the maintenance, all of that. Your car sits there 97% of the time. You only drive your car 3% of the time. That's about to change, and that's going to bleed over into transporting, goods and services too, because they're going to have autonomous trucks. This is another way that you're going to see costs are coming down. Also in housing, this is what you're looking at right here. This is the 3D printed house. It's a graphic of a 3D printed house, but I encourage you, go to YouTube and just type in 3D printed homes. You will see videos of these massive machines that are able to actually 3D print a home in less than 2 days, an entire home, for like a tenth of the cost that it would normally cost you to actually build a home with wood and concrete and all of the work that goes into it. They're going to be able to do it for a fraction. So you're going to see housing go down because of technology and because of, Zoom and remote working and taking autonomous vehicles. You're going to see people are not going to be living in the big cities anymore. And we already see this right now. Out in Riverside County, the market is on fire right now because people are realizing, if I don't have to go into work every day, if this is the new norm, I want a bigger place and I want to move somewhere where it's not so expensive. So we're going to see 3D printing is going to bring the cost of homes down. Medicine. Guys, we had the fastest vaccine to a pandemic in history. And it was because biology and artificial intelligence and robotics have merged. We sequenced the human genome at the end of the 90s, the beginning of 2000, and it cost over $100 million to sequence the human genome. Now you can get it done for less than, $1,000, in some cases just a few $100s. And so they're treating the human body like it is a computer program. They're able to go in there with a few SNPs using CRISPR technology, and they're able to take artificial intelligence and figure out the best way to fold proteins, the best way to edit genomes. And this is going to bring the cost of healthcare down. It used to be that, they used to, the organizations that ran healthcare, right, were pharmaceutical and doctors, right? I mean, your insurance companies were at the mercy of doctors. And this is why our premiums went up. And the majority of our GDP is taken by medicine, because we've been treating people instead of treating them with preventative medicine, we've been treating them after they get sick and after they get cancer. The majority of money that an insurance company has to spend is when you get seriously ill. If you get cancer, it may cost them $1 million. Well, if the insurance companies can help pay for preventative medicine to be able to diagnose you quicker and to stop you from getting cancer and to stop you from getting Alzheimer's, or to help you recover quicker, then the insurance companies are going to do it. Why? Not because they're humanitarian. It's because it's more cost effective. So we're seeing the cost of healthcare is coming down, and it's going to come down dramatically over the next 5 to 10 years. And then also education. Education, all these kids that are not working, that are not going to school right now, they're learning a new way to be able to learn. Why would you go pay, hundreds of thousands of dollars to go to Harvard if you can take a Harvard class online for pennies on the dollar and earn that same type of degree. And when you're doing that digitally, instead of, having 300 people in a classroom, you can do it to 30,000 people that are all paying a fraction of what a person would be if they were physically in the location. So all of this is bringing the cost of living down. So I would not worry about inflation right now. I don't think that it's a big deal. So this year we hope to see labor force is hopefully, it's down right now 10 million. Hopefully it's going to come back and it's going to alleviate the supply chain. And then also we expect additional spending under the new administration is going to increase the supply of treasuries to be sold. We expect that the new administration is also going to be putting trillions of dollars into an infrastructure program that will get Americans back to work as well. Rates are likely to bump higher, before resuming downtrend. We see this a little bit right now. Rates went up like, I don't know, about a quarter of a point in the last 2 weeks, but now they're coming back down again. Don't pay attention to a little blip like that because rates go up and down every day, sometimes several times a day. So here's what we have to look forward to, guys. There's hardly no inventory out there right now. And we know the average age of a homeowner is 33 years old. Now you can go back 33 years and you can see that the millennials that are just now turning 33, there was explosive growth in births over the next 3 years. So we can expect an explosive amount of new home buyers coming onto the market. These millennials that are 33 years old or higher are going to be on a major buying frenzy. It may not be all in one particular location. It might be more spread out, but we anticipate most of the people in this industry and most of the economists that I listen to believe that we're going to see 3 very strong years of real estate growth. So the one thing that, I'm going to show you in a minute, one of the reasons why the market is so red hot right now is because of supply. There's just no supply. We're literally at the lowest rates in history right now of homes that are available on the market. Now, there's lots of reasons for that. Some people don't want to sell their house because what are they going to go buy if there's nothing available? Some people don't want to sell their house because they're terrified of COVID and they don't want the, strangers to come in their house. Some people don't want to sell because, maybe they just they're insecure about their, their work prospects. But also we know that one of the reasons why the supply is so low is because there's been this massive interruption from COVID. Builders put everything on hold for about 6 months, and this caused a massive decrease in the amount of new building starts. So now a lot of people, I just got into a conversation with my best friend about this yesterday. He's like, oh, well, what happens when all of a sudden there's no more money out there and people are getting evicted and you're going to see homes foreclosed on it? Folks, this is not 2008. That was actually caused by the mortgage industry. Here's what we know. The majority of people that own homes today, they have a ton of equity in them, even investment properties. And the majority of people that own these investment properties, although we know that we had a rental relief bill that was passed with the CARES Act, and there's going to be another one that comes up that is giving renters a break. Homeowners have also been given a break, with the forbearance aspect where you didn't have to make mortgage payments if you couldn't afford to. Now, I definitely don't want anybody to go into forbearance. If you can afford to make your monthly payment, you should make your monthly payment. But with that said, if you're one of the few people that, that you're stuck and that's what it's there for. You shouldn't have to make a choice whether you should pay your mortgage payment or feed your family, right? But we know that the majority of the vacancies out there are very slim. The vacancy rate is one of the lowest in history. Folks, look at this. This is 2020. The only time it was close was in 2001, where the vacancy was this close. And then we had to go back to 1981 and 1982. So if you're a landlord, why would you let your place go or sell your place if there was a line of people looking to rent your place from you and at a premium? We're going to get over COVID. COVID is going to be a thing of the past. And we're going to have to figure out a new way to be able to treat these people that need to buy or rent homes. Now, this is the mind blower to me. We are at all-time record low inventories, folks. People talk about bubbles. This was a bubble. Back in 2007 and 2008, when there was, just a massive amount of inventory on the market, which, was, sparked by foreclosures and whatnot, that was a bubble. This is not a bubble. This is hardly any inventory on the market. So the likelihood that we're going to see some huge event that's going to take place where all of a sudden there's going to be, 10 times the amount of houses on the market, I don't know. I don't see it happening, but I'll let you make that decision based on the information that I just gave you. We know that right now is the best time to buy since 2013, and I'm going to show you why. This is a home affordability index, and this is showing that the home affordability index today, this is actually dated a little bit because it was 2020, was 172, and the last time it was better than this was in 2013 when it was 176. So this is a chart that I did for a client that kind of speaks volumes. This should drive the point home to you. 2 years ago, the average interest rate was 4.7%. I used 4.5 for this illustration. To buy a $650,000 house, your principal and interest payment at 4.5% would have been roughly about $3,129. Today, with interest rates somewhere, under 3%, I use for the purpose of this illustration 2.75%. This is if you got 20% down, you got great credit, it's a single family residence, it's your primary residence. Rates are generally somewhere in that neighborhood. But at 2.75, your principal and interest payment would have actually been lower on an $800,000 house than it would have been on a $650,000 house just 2 years ago. So right now is a good time to buy, you guys. Interest rates are going to remain favorable. The key is having a great team so you can get an offer accepted, because I can tell you it's a battle out there. I was just talking to my friend and realtor partner, Christina Hudes, and she told me the story about how this one house she had her eye on had been on the market for 5 hours, and they had 70 appointments, 70, that were scheduled to come view the home. The listing agent had to take it off the market. We're seeing 10, 15, 20 offers going in on one property. And we don't see this slowing down anytime soon. Now, if interest rates pop up a little bit for whatever reason, we could see it slow down again. But like I told you, the general consensus between the economists that I'm listening to and the market movers are saying that interest rates are going to remain relatively low for the next several years. We see high demand and tight supply. Now, the average appreciation in 2020 is 6%, but I heard in Orange County, it's as high as 10% is what they're expecting. I was just talking once again to Christina the other day, and she told me about how, she had a client, the asking price was $850, and they were going in there, and there was already offers on the table for $630,000, $50,000 more than the asking price. So you do the numbers. You can see things going up, very quickly. So this is all I've got to share with you guys. I encourage you, please share this with somebody you think will get something out of it. It's for educational purposes. I'm just trying to share with you what I've heard and what I've seen. If you guys need anything, hit me up. Let's do a Zoom call together. Let me see how I can help you. If you're a realtor, a financial planner, an attorney, you've got clients that would like to talk to somebody like me, I would love to talk to them. Most importantly, I just want you guys to be successful in 2021. I'm so happy that, that we're over what I would consider to be the worst of it. And I hope everybody is just trying to do their best to stay empathetic, to help other people, and to try and remain positive. Happy New Year, everybody. Hopefully we'll get to be talking to you soon. Take care.